Welcome to Market Movers. I'm Jim Uriel with Scott and Martin.
Hi, Jim.
Okay, so we had a bad ISM number. Has everybody believing that we're heading into a recession? The big number, the NFP number, comes out on Friday. Will that pull us out of it?
It could change the perspective, I think, Jim, for sure, because of the fact that I still believe job numbers and GDP numbers are really the key drivers to how the stock market's going to perform going forward. The weird thing to me, if I may throw in a little editorial here, we knew the manufacturing sector was slowing. We've seen that in the business confidence numbers. It finally just showed up in the actual numbers themselves.
Is the Fed a counterbalance to bad data?
Probably, yes, but it's depending if they get the hint, Jim. As we've seen, the Fed has been kind of fighting internally as to whether they wanted to ease, how much they wanted to ease, and if they want to ease at all.
Before we head into our trade discussion, I'd like to point out that these are examples, not recommendations or advice. Scott?
Yeah, Jim, so things are going pretty wild today in the EF, let's say it to
yes.
name a word. So in that aspect, in that event, I think these are nice opportunities. These are days I get excited to film shows like Market Movers, because there's certain things that you should take advantage of and certain things that I'll show you as an example that might be good ways to kind of, let's say, just look at this market in a different way than maybe, say, the traditional way would tell you. So as an example today, Jim, I'm looking at buying the week 2 2875 2900 ES call spread for 13 ticks. Sounds great, doesn't it? But Jim, as usual, in this type of market, in this type of action, I want to pay for this. And I'm going to do that, my friend, by selling a 27.75 put in the ES for 13 ticks. So this trade risks me getting long at 27.75 if we break that. But it also has a max reward of a potential of $12.50. It expires October 11th, so it goes through the end of next week. So through the jobs number, the underlying, as you mentioned, I believe already, was 28.80. And it just is a nice way to express yourself when it comes to maybe taking advantage of some cheap call spreads that are out there.
I actually do like it. I don't like it a ton, and I'll tell you why. I like it, though. Vol has screamed. The VIX is over 20. That 27.75 put is going to be jacked up in price.
And nobody wants calls right now.
Right, and nobody wants calls right now. So, but you have to underscore the fact that the risk is being long at 27.75.
Sure, and look at the charts too, and look at 27.75 on the charts. There's a little bit of a line in the sand there, so I'm defending it as we would.
It's so funny that we talk about that 27.75 level, because I'd like to get to mine, which is the East Micro buying at 28.75, which I think is that level, because it is an important trend line with a target of 29.30 on the upside and a stop placed at 28.40. Now, I think you and I both have the same thesis here, and that's that it's a bit of a panic going on right now, and everybody's selling things, so it might be a little overdone.
A lot of rushing to the exits, it feels like. And what's interesting as well to me is when you get markets like this that either go either way, extend to the top or the bottom, you start seeing levels that are nice and important. I believe that markets and computers and algorithms really start to carve out. 2900 is one of them, 2875 is one, and 2775 is another.
Quick question, we haven't mentioned the tariffs. What's the risk on the tariffs? That they get settled or they get worse?
Worse, considerably. I mean, I think easily that they get worse. Or, Jim, if I may say, I know I've talked a lot here, is if they don't do anything with the tariffs, because more uncertainty that drags out, the longer this goes into the future, the more the market starts to worry.
Thanks for joining us on Market Movers. I'm Jim Uriel, where we are helping to make you a better trader.